Hey everyone, me Kevin here. The Federal Reserve minutes just came out and so far the market likes them. What's there to like, and were there any red flags in this? And the answer is there were some red flags in it, and we gotta pay attention to these, and there's also some good news in it. Let's get right into the actual document. I've already gone through and highlighted the most important parts. Okay, so first of all, market participants appeared to view a moderation of inflation and slower but still positive economic growth. This is really important, okay? A lot of folks in the comments, I see this over and over again. I think it's important to address, mostly because I think there's a substantial misunderstanding here. Watch my video as well this morning if you haven't yet, because we touch on this a little bit more in depth. But a lot of folks are wondering, how could you have slowing inflation and still have declining inflation? That doesn't seem to make sense. And the answer is yes, you can. Because, for example, if Apple makes 100, let's make that a little smaller. If Apple makes 100 iPhones in, let's say, 2021, and there is a demand for 110 iPhones, this is demand, this is supply, then what ends up happening is the price of these phones goes up. Now, you can actually go into 2022 and you could end up having supply catch up. In fact, you can actually get a little bit more ordering going on. You could have 115 phones. And then you could have 114 phones worth of demand. In this scenario where supply actually slightly exceeds demand, you generally won't raise prices. But what are you going to see? You're going to see net growth, more revenue, more selling. So no inflation while still having more product being sold and more product being produced. Now, some of the other comments that are going around about this, but how can inflation go down if people keep spending more money? It's because of all the money we printed. Do not forget, folks, because this is a very common thing I'm seeing in the comments, is people like, well, we didn't have this inflation problem in 2009, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. You know, like now we printed all the money. That's why we have this inflation problem. Wait a minute, we actually started QE in a substantial manner after the Great Financial Crisis in 2009 and never really ended it until 2018 because we started trying to taper, but it never really worked. We really didn't taper until 2018. The market had a hissy fit and the Fed U-turned on it. So no, we've been printing money for a very, very long time. It's a precedent that started back in 1987 with the Fed bailing out markets, okay? So these are important things to learn. Yes, you can actually have inflation going down while at the same time the market does better, which is very, very, very bullish for stocks. And this is why I'm all in, okay? I know people are like, oh, but the Fed's gonna have to raise rates to 5% or 6% or 7 or 8% to crush this economy. I don't know. I don't see it, and neither does the bond market, but let's go through some more of these notes. Market participants perceive falling commodity prices. Okay, we've seen this a lot, but they do also mention, some of these things I'm just gonna kind of give you a summary on. They do mention that this is actually a potential risk, right? If commodity prices are plummeting and that's kind of what's pushing down inflation readings right now, well then if some kind of shock happens to the commodity sector again, well then you could see the opposite happen, right? You could all of a sudden see this big push right back up where inflation goes back up because commodity prices start rocketing back up. But so far, lumber plummeting, oil plummeting, nickel plummeting, wheat plummeting, we're seeing them all plummet. It's pretty incredible. All right, let's keep going here. Nearly all this was bullish in my opinion. Nearly all respondents anticipated and ended up voting for the 75 basis point hike in July, but most of them expect a 50 basis point hike in September. The market is presently pricing in a 60% chance that we're going to get a 50 basis point hike in September. The Federal Reserve is also projecting that they expect to get to a peak Fed funds rate of about 3.4% based on their SEP. That's also what the market implies. Now, what's interesting there, though, is the following. The projection for the U.S. economic activity prepared for the Fed was noticeably weaker in July than it was in June. I personally found that really interesting because we did not get a summary of economic projections from the Fed in July. They skipped that meeting, and that's okay, that we were expecting that. But we got a pretty bearish one in June, and they're basically saying the economic data that they got for July was even worse. So they're definitely starting to see that slowing in aggregate demand, which an overall slowing of demand while at the same time seeing supply chains improve is very, very important. you always have risk sides to the downside. Supply could end up going to crap again. China could have lockdowns again. It could, force Tesla to raise money because, if China's locked down, they're going to have to. But fortunately, we're not seeing that right now. Knock on wood, right? So anyway, you've also got the potential that inflation and commodities run up again, and that leads to more problems. In fact, across the world, the Fed notes that they're still seeing a broadening of price pressure to core goods and services. This is for foreign markets, and that is a red flag as well. Long-term borrowing costs declined for households and businesses with great credit and is still readily available for folks. I'm going to make a separate video discussing this idea that, consumers don't have money anymore, that they're going to stop spending, that they just maxed out their credit cards. We'll make a separate video on that because there's a lot of rumor going on about this, that the consumer's about to get reamed. I'm actually not seeing that in the actual data. People talk a big talk, but when it comes to actually providing data, they don't. Everybody's got their opinion, and that's okay. Anyway, mortgage underwriting standards better than in the previous cycle. Now commenting about real estate, having houses in the housing market with substantial equity cushions left over. This actually ends up turning into a red flag. Let's go ahead and jump ahead to that red flag. Is that even though mortgage standards are better and home equity cushions are higher, they believe that it's going to remain appropriate to, once they hit peak Fed funds rate, to stay at that rate for a while. In fact, their phrase is, it would likely be appropriate to maintain that level for some time to ensure that inflation was firmly on the path to 2%. I wrote housing here because I think that is going to be a continued drag on the housing market. And off peak, we're probably going to see declines in the housing market, depending on the area, between 10 to 15, maybe even up to 25%. Nothing like what we saw in 2008. That's not what I'm expecting, but I do think we'll see some 10 to 25% price reductions off of peak, which probably will end up having been somewhere like March or April, and we'll probably see those lows sometime in early to mid 2023. So you want to be prepared for that. Obviously, I do have programs on building your wealth with real estate investing and stock investing, building your wealth, whatever it is. Becoming an agent, great opportunity now. Check that out, link down below. There's a coupon code expiring August 26th. And then once we launch the Series A, the price for those courses is going to skyrocket too. So you may as well get in before that. All right, so participants also judge that there was a significant risk facing the committee that elevated inflation could become entrenched. This is a really important line. So they're giving us this red flag, a few red flags here, right? They're telling us, hey, we're seeing the economy soften. At the same time, commodity prices are going down, which is pushing inflation down. But inflation could jump back up as commodities go back up. And the economy is softening. So our tightening is taking effect, though it'll probably take more time. In fact, they say, many participants remark that in the view of constantly changing nature of the economic environment, monetary policy's effect lags. So the economy's reaction lags to what the Federal Reserve is doing, right? And they've gotten pretty tight. So that's very, very important. So we've gotten these red flags, right? We've got red flags that potentially inflation could go higher. Fortunately, it's not. The red flag that once the Fed gets to peak, they're going to stay there for a while. That's a red flag for real estate. So red flag on inflation, red flag on real estate, red flag on supply chains. Right now, supply chains and inflation are going in the right direction, but there are reasons it could go bad. 10-year treasury yields, which generally precede what the mortgage market does, are sitting at 2.9%. We've actually, about 2.88 now. We've actually ticked up today rather than down. We're having this weird situation where it seems like we want to hang out somewhere between 2.7 to 2.8. That means mortgage rates sticking around somewhere between 5 to 5.5%, 3% larger than was in the past. So again, supply chains, real estate, inflation. Real estate, the one that is actually affected the most by the Fed keeping a restrictive policy for longer. So if inflation does and pulls something that looks like this, where it runs up really fast, but then it kind of like momentum bleeds out like this long and drawn out decline is going to be very bad for real estate, but it actually will probably be good for the stock market. And so that's why I do think there's sort of a macro trade in there. I don't consider myself a trader, but I would consider myself a macro trader. So, okay, so let's see what else I have. So we've talked about some of the red flags. We talked about real estate. Yes, remember the expectation, we were just getting ready to talk about that the Fed has this job of making sure that inflation expectations remain anchored. And one of the concerns that they had was that they would lose credibility. And they talk about that again in this, and they've previously talked about this many, many times, that if they lose credibility on their fight to get inflation down, then they will fail, because that could be self-fulfilling. You could entrench inflation expectations, unanchor them, and then all of a sudden inflation stays high. That would be very, very bad. And this is why the Federal Reserve has so frequently come out, and they do they have these sort of days where they just, three of them will come out and talk and say, the Fed has an undying motivation and unwavering commitment to get inflation down. We will win, you know, and they really talk the market down by doing that. But they're also doing that because they have to. It's part of their job. This, though, tells you what the bond market thinks about inflation. I'm going to hide myself for a moment here. The bond market is predicting that inflation should be trending down. It's not going to be straight down, as you could say here. It goes through these sort of peaks and troughs here. But this chart tends to move about 3 months before inflation, 3 to 4 months. So we just had inflation come down for July. And what you'll notice is if you go 1, 2, 3, about 3.5 to 4 months, right here, 3.5 to 4 months before that July read, what do you get? You get the bond market saying, oh, we're seeing signs that inflation is going to come down. So we might stabilize here for a bit for the next report, because this could be what we get in September for August, but then we're really expecting to see some notable declines here in inflation towards the end of the year. Again, this chart here is trying to predict inflation about 3 to 4 months ahead of time, and it's the 5-year break-even chart. And it's also a way of seeing what inflation expectations are, which based on consumers and based on this, so far are anchored and good. Now, what's also really remarkable is not only the Fed, again, referring to this slowing, particularly in the housing sector, but take a look at this. This idea that GDP growth will eventually, that a period of below trend GDP growth will help reduce inflationary expectations and pressures. That's really important because they're saying, hey, actually this negative GDP report that we just had could be a really good thing because it helps us get inflation down. In addition to that, we have this weird thing going on where technically we're in a recession, but the labor market doesn't say we're in a recession, so there's a dispute over this, and like Biden redefining the definition of recession and all this. Whatever, that's all politics. But what's neat here is the Fed is actually thinking that ultimately GDP will end up getting revised upward, and in like a looking backwards way, we won't actually end up being in a recession. How weird is that? We could feel like we're in a recession, we could be told we're in a recession, and then in the future, no, just kidding, we weren't actually in a recession. Kind of interesting. They are starting to notice some signs of softening labor growth in the job market. We talked about the housing danger, and then again here that is with the committee facing a significant risk of letting inflation expectations run away. So what do we have here? In my opinion, we have 50 basis points coming in September unless we get a terrible CPI report in September. The stock market is actually enjoying this. The stock market sold off earlier today. Tesla was down as much as 2%. We're now seeing Tesla in the green. We're seeing QQQ only down 0.5%, trying to go green along with Enphase here. Target, we did a very deep dive fundamental analysis this morning into reading between the lines of what Target actually said in our course member live stream this morning, which I thought was really incredible. Check out those courses linked down below. Be aware, this housing, the longer the Fed stays at these high rates and the longer that 10-year treasury rate remains high, which is really around 2.7, 2.8% or above, which is where it is now, the more pain there will come to real estate for longer. Real estate does not move very fast. It moves very, very slowly. And that means that if this 10-year treasury keeps going up, you're going to see pain in the real estate market for longer. And it is an opportunity for you to buy. I highly encourage you subscribe, by the way, because I am starting a real estate startup, and my intention is to bring a lot more real estate content back to this channel. The reason for that is I'm going heavy into real estate once this company launches. I'll actually be selling a lot of my stocks over time, over the next year, and I expect to be substantially heavier in real estate again, which is all in line with exactly what I plan to do when I said so at the beginning of the year. For those of you who don't remember, on January 21st, I sold all of my stocks. I fielded Q&A for about an hour when I discussed that I sold all my stocks in a course member live stream. I tweeted that same day, sell, and then it took me about 10 to 12 hours to put together a really good, thorough video, which I ended up posting the next day. And what's really incredible is, sadly, some people are very, very upset that I sold and somehow should have given them more of a heads up. And I thought, my goodness, you know, within 24 hours, putting together a big detailed video, you'd think that would be like enough, right? But no, it's not. People got mad at me. They're like, oh, you should have told us earlier. And I'm like, dude, even if you ended up selling the next day, you could have, you would have still been up. Like the NASDAQ was up from Friday to Monday. So it's like, come on, folks, and look at how much pain you had ahead. I think some people just honestly don't want to take accountability for their actions. I try my best on this channel, and I do feel like I'm one of the very few people who will actually take a stance, which unfortunately is very risky, because if people perceive your stance as wrong more than it's right, then they feel maybe they can trust you less. I don't believe that's the case. I've certainly made mistakes, but I think I've been pretty damn right on over the last year in terms of the market. Again, yeah, has it been perfect? No, of course not. Nobody's perfect, but I am very, very confident that being all in on this market is the right move. Mostly got in between March and May, June, and a little bit more here recently when we hit our old 318 level on the QQQ. And now I'm just waiting for the stock market to do its thing, and as soon as it does, I'm transitioning over to a lot more real estate. So, which is also when I expect the real estate market to kind of be towards a lull or a low. Or both. Anyway, can't please everyone, I guess, but I'll keep trying. I'm not leaving. I'm still here. It's been painful, but I'm still here. Thanks, everyone. Bye.